Welcome to Institutional FX Uncensored, your free weekly FX podcast. Listen to professional FX traders, currency hedge funds, and FX brokers from around the globe discussing the latest FX news, trends, and regulations. Be ready to navigate through the uncharted waters of the foreign exchange market like no one else has. Tune in.
Hi everyone, my name is Natallia Hunik and I'm the host of Institutional FX Uncensored weekly podcast. Our series of shows are for professional FX traders, high net worth individuals, currency hedge funds, and FX brokers from around the world. Here we discuss and debate the latest FX news, trends, and regulations like nowhere else. It's my great pleasure today to introduce to you Demetris Tsingis is a good friend and an industry colleague. This is not the first time we're sharing the stage with Demetris. And today we will be talking about mergers and acquisition trends in margin FX sector in 2021. There's quite a few topics we wanted to cover today. So Demetris, welcome to the show. Thank you so much for joining.
Thank you, Natalia. It's always a pleasure to be hosted from you, and always very interesting what you have to say and ask as well.
Hopefully today you have more to say than I do. Great. So Demetris, let's share with the audience a little bit about your background and your success story. And that's where we met, prior to starting your own firm. You worked at a marquee consulting firm in Cyprus called K. Tripidis & Co. What prompted you to start your own advisory company?
Yeah, I mean, I've been 20 years now in financial services. I started in 2001 in London. So I kind of figured out that, with all this experience at some point, I should become an entrepreneur as well. I'm doing a PhD on entrepreneurship. So it kind of affected me in the sense that I should start up my own business as well, instead of just studying about people that did. So I guess.
So it was a practice exercise that turned to be a success.
Well, yeah. It was never the plan. It just happened. I'm fortunate enough to call it a success today. A lot of hard work. Our team now and associates, we're over 60 people, and we're very proud to be one of the top consulting firms in terms of financial services, and more so in M&A and acquisitions. I believe we're perhaps the most successful in this industry. We're involved in over 50 successful closed deals in various shapes or forms. So very happy to be involved. Advisory and M&A is something that I enjoy passionately. So
great. Thank you so much, Demetris. So let's dive into the M&A, actually. So something that I wanted to talk today about is Finalto sale by Playtech. So I'm just going to read a couple headlines, and I have here on the screen some financial numbers. So Playtech confirms a $210 million sale of its Finalto financial trading division. The cash offer from the consortium is up to $210 million, comprising an initial $185 million, of which $15 million is deferred to up to 2 years from completion. A further $25 million is contingent on certain cash flow or other criteria being met by business carried on by Finalto Group. Formerly known as Playtech, the division secured revenue of 121.9 million euros from 2020, representing the growth of 80%, and adjusted EBITDA of 56.4 million euro, up 623%. So it seems incredibly successful 2020 with really good numbers. What are your thoughts? What do you think prompted the sale?
Yeah, I was there when Playtech actually bought Markets.com for over £400 million. It bought CFH, it bought ACM. The combination of these three entities created basically TTA, TradeTech Alpha, which then got rebranded into Finalto. I believe that the sale actually is impressive in terms of the amount for Playtech, because this group, this merger, I believe anyone knowledgeable of the industry knows that there was a value destruction when you combine these three firms together. So a lot of key people left, a lot of things changed in these three entities, and this basically made the sale of Playtech, I think, in my eyes, successful versus what they could have got. I think they rode the wave of the 2020 crazy year that FX CFD derivative brokers had. I don't think that 2020 numbers will be sustainable. And I would see more.
Yeah, there's some incredible growth here.
Yeah, well, I think it's an outlier. I don't think that this is going to be sustainable. And I think that 2019 numbers are more a proper reflection of what we expect to see in the future. Now, Finalto has been bought by a series of investors, a consortium of investors that are not necessarily strategic. I heard about like an insurance company and certain regulated guys going in. It's not necessarily a strategic buyer. It's not, for example, a competitor that bought it and merged the book into their own entity. It's a consortium of investors. I think that the deal was very high because of 2020 numbers. Given all the problems that this entity had with key people leaving, loss of revenue, regulatory headwinds, 2019 was a much better reflection of what they would be expecting. So I think they rode the wave. They were very fortunate in their timing. I think that the buyers of Finalto will be looking at 2021 numbers and they'll be potentially wondering if they overpaid. That's my take on it.
And to your point, I think you made a point about the buyers not being strategic investors, not people from the industry. And, they took a reference from 2020 right now. In 2021, particularly, we're recording this in June 2021, FX industry relies upon volatility quite a bit. The volatility numbers have been disappointed, to say the least. I'm sure it will be reflected in everyone's financial results as well. It does appear that not having investors from the industry. Do you think the people who invested, they made this wrong assumptions based on abnormal, as you say, it is an outlier 2020. I mean, we had the once in a lifetime pandemic happening in 2020.
Yeah, I am of the view that, of course, the guys that were advising on the buy side, they're investment bankers, they know how to run the numbers. However, if you're an industry insider, you know that these numbers are extraordinary, to say the least. And the unparalleled success of the FX brokers and derivatives brokers during 2020, there's a high probability they won't be repeated. Regulatory headwinds, leverage restrictions of 2019 showed their impact, and I believe nothing's changed of that. The fundamentals of the industry have not changed so dramatically to be so optimistic for the long-term view of the multiples. I just think that they had a fantastic year. You never buy something when it's peak, but you always sell something when you're at peak. If you're if you're a trader. So I think that the sellers knew what they were doing.
Right. So it's a good call by the sellers. Demetris, so I've run some numbers. As you mentioned, Finalto brand consisted of other brands that were rolled in throughout the years from the same vertical. It's financial technology firms, it's brokerage firms. So some of the acquisitions that happened in 2015, 16, 17 at CFH, Alpha, TradeFX, they were, I mean, if you look at the multiples, and given the fact that 2020 was an incredible year for the FX industry, incredible year for Playtech as well, we still look at I mean, EBITDA multiple of for the initial consideration of about 3x versus the other acquisitions that were made throughout the years at much higher valuations. What do you make of these numbers? Do you think, I know, and we just discussed that they exited at the top, but yet when you look at the multiples, it's, it's still at least, I mean, in some cases, 2-3 times lower than the previous acquisition. So it seems like those investment bankers do know how to run the numbers.
Yeah, no, yeah, but I think that you have a very important shock to the system that needs to be factored in by any investment banker. The 2018 leverage restrictions of Europe basically changed the industry forever, and the profitability of the industry forever, and the model of the industry forever. So if you're comparing numbers before 2018, and we're comparing numbers now 2021 post-pandemic. So if I were to remove these two shocks, first of all the leverage restrictions, and second of all the pandemic, I would be able to compare them like for like. But as we have seen in 2019, the numbers sucked. The margins were very low. A lot of brokers left the industry. They just exited because their model was wrong. They were working call center model. You remember that Marcus.com, that was the biggest chunk of the Finalto sale, had call centers all around Europe. They had 400 people call centers. That's gone now. There's no such concept now. So the whole model changed. Then leverage restrictions blocked them. And now they're competing on a level playing field with people like Plus 500 and eToro and automated systems that no one talks to anyone, but it's making money. And these guys are gonna have a tough time sustaining their numbers. I think that they, the sellers nailed it in terms of timing. I think the buyers,
absolutely,
they might think that they had a fantastic year. I hope that fantastic year paid some of the premium they had to pay, but I fear that it's not going to be, sustainable. I don't think that the numbers will be sustainable.
It's interesting points, Demetris, that you are making about normalizing the multiples. When you're looking at the multiples on the exit in 2021, you can't compare those numbers to 2015-16 because the industry has undergone such massive changes as MiFID II regulation came in and the leverage dropped, as well as the other regulatory restrictions that were happening all around around Europe. So would you think it's fair to say that the multiples have gone down from the numbers we've seen in the past for FX businesses in general, or is it just for FX businesses associated with taking the risk, like aka FX brokers versus fintech?
Yeah, I couldn't agree more with that assertion. I mean, I think the multiples have gone down simply because the profitability of these guys has gone down. They have found new revenue streams in terms of crypto CFDs, and they rode the crypto wave, which potentially has increased their numbers fictitiously versus their standard offering of CFDs and so on. It would be interesting to see what percentage of revenue and normalize it with the crypto CFDs. So a lot of people are doing crypto CFDs because it was the craze in the last couple of years, and they were riding a very let's say big wave in terms of crypto. That was also an element of profitability for these companies. I think a lot of these numbers enjoyed success because of the crypto. I'm not sure what that, if the SEC tomorrow woke up and said, guys, whoever trades crypto needs 1, 2, 3, 4, 5 conditions, otherwise, and you need to be KYC'd, and you need to do this, you need to do that, etc., etc. Suddenly, the market lost its favorite toy, and somebody was telling me that 70% of plus 500 volume is crypto related.
Wow, that's a big percentage.
What would the numbers look? If suddenly some announcement by the EU regulator or the SEC watchdog would say, crypto, end of the line.
Right, and speaking about crypto, it's very good for. It's been very good for FX brokers, as you mentioned, and you also provided some numbers about the plus 500, which is incredible. But we also remember when IG started offering crypto. I think it was on the first, second technically, rally for crypto in 2017. In the first quarter that they did that, they lost $400 million. So it is, while it is incredibly profitable, it could also be pretty devastating in terms of the risk that you take and the losses that, as a result, you may have to absorb. I'm sure a lot of FX brokers, and we all know that there was, especially in 2020, the numbers that we see even for Playtech, there were great numbers because there was a lot of FX volatility because of the pandemic shock. However, the volatility, steadily subsided, and right now in June 2021, the volatility is kind of back to those miserable 2019 years. 2019 numbers, and a lot of people are starting to look at other asset classes like crypto and single stocks, because that's where the volatility is. So if you want trading volume, you want transactional revenue, you have to offer those asset classes. But especially crypto, it's a completely new asset class with a completely new subset of risks and other considerations. That I wonder if FX brokers have, they don't necessarily have a core expertise in that type of asset class. What do you think we're going to see on the balance sheets next year? Is everyone going to be profitable, or is it going to be a massive hole in everyone's balance sheet?
It's an interesting discussion. I heard that eToro made an unbelievable amount of money because they were the first investors in Ethereum. A lot of these guys, because crypto exchange is very similar to online brokerage, and at some point everything merges together. You're a broker of everything, a broker of stock, a broker of stock CFDs, a broker of crypto, an exchanger of crypto. A lot of people focus on user experience and making sure that, if I could take a crystal ball and see in the future, I would see, in 10 years' time, you'll have one app that will govern your pension savings, your insurance savings or payments, your banking, your investments, your optimal, let's say, pattern of consumer behavior, financial consumer behavior. You'll have, this AI reading all your payments to everything you buy and sell, and they will be giving you recommendations. Buy this fresh pre-IPO stock, invest, in 10 Bitcoins, do this, do that, and it will be one app. And I see this kind of like Robinhood, eToro, user experience where it's one-stop shop, everything is tied together. Your payments, your banking, your insurance, your savings, your everything, your whole life. I think that's where we're going. Even loans, challenger banks are going to basically demolish what we know about traditional banking. Only investment banks will survive, in my view. The rest of them
Let's
will
hope
just...
I think, that vision, certainly, I think it's credible and plausible, and let's just hope that it delivers all those benefits to us, to the end consumer, because it is convenient, right, to be able to access all of it from just a single application and have a robo-advisor tell you what to buy and what to sell.
But that's
a bit futuristic.
But that's what's going to happen, because these Finalto guys, if they don't move towards that single total user experience that Robinhood is doing and eToro is doing and so on, and they don't merge everything together, the users will just move there. Think about it. Revolut. they started doing the exact same thing as, and they did it the other way around. It's not like Saxo Bank, they started FX, then they became a bank, then they started doing stocks and bonds and everything and so on. Revolut started saying payments, then they became a bank. Suddenly they give you access to investments. So sitting in my, let's say I'm a user, would I trust Revolut Bank that is huge and has access to everyone and so on? Or would I go to XYZ Forex firm to do my investments? You're going to be
absolutely certain. Challenging times for FX brokers. Yeah, more competition.
In a vicious cycle, I think, like a Kodak versus digital photography kind of thing. If you don't migrate very fast, and the guys that merge and become really big and merge all the financial services into one app, they're going to survive this onslaught of the big guys. And it's a matter of numbers. So Apple Pay, then who stops Apple saying Apple Invest, Amazon Invest, Facebook Invest, Facebook Loans. So I think that these numbers, obviously this industry is like, very shrink. There's multiple forces shrinking it, growing it. There's multiple forces at play, but I think the numbers are not going to be repeated, especially for single trick ponies, like people that do one thing, they do FX CFDs, they're going to have a tough time in this industry.
Oh, you're painting not a very rosy picture, Demetris, for our listeners who are in the FX brokerage business, I'm afraid. But at some point, everyone has to face the reality, right? Face the music.
Well, I think there's going to be a lot of M&A. There's going to be a lot of M&A, which is music to my ears, because people understand they need to build book. They need to build the book. They need to become huge, reinvest it all in tech so they can become one-stop shop user experience. I mean, it's simple.
Yeah, absolutely. And you're making the great points about competitors coming from the fintech industry. I think even here in the States where I'm at, a lot of banks kind of neglected the fintech companies, that they're not a competitors, but now all of a sudden they become competitors and they do things that banks did traditionally better, faster, and consumers love it, right? So everyone, while you can underestimate the technology is kind of a determinant factor in 2021 about look at the tech stock valuations, they are through the roof. So technology has taken, I think, a new leap of faith from the investors because of the pandemic, likely. But a follow-up on what you just brought up about the intensified M&A activity in the sector, it's interesting that you mentioned that, because recently at the show in Dubai, I had a lot of brokers kind of come up to me and saying, well, what kind of multiples can I expect if I sell my company, my brokerage? And that's why we were talking about multiples, because I was like, everyone is asking about it. We should talk about it on the podcast. And I think, to your point, that M&A activity is going to be on the rise. And from where we started our discussion about the Finalto sale, I think perhaps a lot of brokers are looking to exit at this time, looking back at 2020, great numbers. Just like Finalto, everyone is looking at it and thinking, look, volatility is subsiding again. Perhaps this is the good time to exit, because, what the future holds for, the next decade, we don't know, but we had an incredible year, and maybe this is the time when I move on and I sell this business and maybe sell it to consortium or conglomerate or strategic buyer, a bigger company or someone else.
Yeah, I agree with what you just said. I think the multiples that people should expect are only going to get lower. Anything close to 2020 numbers would be great. You made a few times the point about volatility, which I agree, but I'll add another number. The number of users, new users, that all these brokers enjoyed in 2020. There were brokers that lifted a big banner on the website saying, no more new clients accepted. We've seen, I was rubbing my eyes. My friends were calling us and said, "Dude, log into that, company. I think it's like IG Index or whatever it was." It says that no more new clients accepted. I was like, I wouldn't believe I'll wake up in the morning and someone is turning down someone that is technology adept and can do everything electronically, so they basically don't need humans, and they turning down new clients. What does that mean? That means that they just had so much business in 2020 because people were sitting in their couches at home, depressed. What am I going to do? Let me trade some CFDs. I heard about this Bitcoin. How can I trade about this Bitcoin? Can I do it, on exchange? No, there's no license. Let me do a CFD, and I'll do a CFD on Bitcoin, and it's not going to be repeated. People are going to, get off their couches. They're going to go back to work. They're not going to be thinking about trading and so much. So I think that 2020 was amazing for volatility, but also the amount of new users entering the space, which was an outlier. Now, if you normalized it with these two numbers and find out the new EBITDA, it won't paint such a rosy picture in terms of multiple.
Absolutely. Well, I mean, we'll see the 2021, is coming to close in half a year. We'll see the numbers fairly soon. We're aware, and I think the listeners are all aware that a lot of deals that are happening in the industry, including the ones that you helped to facilitate, your 50 deals that you helped successfully close, we'll never know the numbers, right? Because they're not public companies. All the numbers are private. But some time ago, I did some research on publicly available information and calculated multiples for the industry subverticals. We already talked about it. We actually already covered that it's likely that these numbers have come down. Do you think anything else has changed? And just to make a point, looking for people who are listening, the brokerage average revenue multiple was 3.38x with a negative EBITDA multiple. And I'll explain why the EBITDA multiple was negative, because I think I did this research in 2016, and a lot of publicly available information on brokers that exited the market, they exited because of the financial trouble, and so it's that is why it comes with a minus sign. The highest numbers actually that I've seen are for the asset management companies with the revenue multiple of 6x and EBITDA multiple of 17x. And software financial services companies are 2.45x for the revenue multiple and 6.53 for the EBITDA multiple. So Demetris, what do you think? Are we looking at the lower multiples? I'm sure a lot of brokers listening, they want to know what number they can exit at. Yeah. And you have some inside info, which I know you can't disclose. Yeah,
I can't comment on the private deals as you kindly pointed out, but I can comment on generic numbers that we have seen in use, because a lot of the sellers or the buyers ask us about this, and we kind of like also indicate to them, definitely it's not going to be a negative EBITDA. So people can relax on the brokerage space. I would be looking at around 6 to 8 on a mature broker for EBITDA. Given the headwinds that I expect, I would be, happy going forwards with the 6. I think the 8 would be aggressive. It would have expected that the numbers of 2020 could be replicated, which I don't believe that in a second. Asset management, the usual number I have in my head is 5%. So 20x in terms of EBITDA, which is very close to what you've quoted there. Yeah. Of course, we're talking about traditional asset management. Now, eToro, that is rumored to be going, the SPAC way of a 10 billion listing. The multiple there, from what I understand, because it's not a traditional asset manager, the multiple there, I think, is much, much higher. But it assumes less cost on the relationship managers, because I used to be an asset manager, I know. The optimal number of clients you have is 70. So every relationship manager cannot manage more than 70 clients, which means there's no economies of scale. You need to step up the cost as an asset manager. eToro, which is let's say an industry kind of disruptive business. It kind of disrupted the way we understand fund management or asset management. They can have much higher multiples because they can replicate without the relationship manager cost. So they have the tech, they can do it, and there's not so much cost. So I would have thought that if you differentiated asset manager versus automated asset manager, the multiple could be even higher. The software guys, that's an interesting one as well. What do you consider under software? Because some people that sell platforms will be one type of software, and other people doing fintech is another type of software. So people actually that develop their own platform and they're doing crypto. In my idea, when they do crypto, they fall into the brokerage space. They're not like only software providers, but a lot of these guys, eToro, they have their own software, but we consider them a broker / asset manager, but they have their own software as well. So they're in all three verticals. Which percentage of the revenue of eToro is on the software part? Which percentage is on the brokerage part? And which percentage do you think is asset management? It's a interesting discussion.
Right. It's an interesting discussion. That actually points to my next question, which is kind of picking on your example of eToro, which is a great example because they have a technology. A lot of people who are asking for exits, and they are wondering what makes their brokerage more attractive to a potential investor. And now that you mentioned eToro owns their technology, I always think that when you have your own IP, when you have your own technology, you have something unique. You're not building business on the third party, just relying on the MetaTrader, for example. That makes your company valuable. Would you agree with that assessment? Do you think that having your own IP, technology, something makes it more valuable?
Yeah, that's a very interesting question. I'm actually doing a deal right now, which is exactly that. It's a company that has both tech and a book. And I find it interesting in the sense that people that are trying to buy them, they have different priorities. They say, oh, you have a trained team of developers. For me, that's very valuable. Other people say, I love your technology. The fact that you have the developers to run it and then improve it and build something that I want is even more valuable to me. So the margin, the premium rises because I can use a trained development team much faster than go and hire a recruiter, pay 15% recruitment fees, wait for 2 years until they become a team, and then half of them will be poached, and then try and run until you develop some technology. The people that deal with tech know about this industry, that it's crazy how difficult it is to keep the right team working at all cylinders. So there's a big value in that. The team, the tech team, and I saw like a very big premiums going to loss-making enterprises simply because they have a trained, ready, compact team that can build anything. Kind of, they can be swerved into or like directed into building something new that has nothing to do with the existing tech. So there's a value in that. Then there's a value in the tech of how you will use it. I'm doing an M&A now of someone that has technology, and I'm seeing buyers that need it, so they value it highly, and buyers that don't need it, and they say, well, for me, I just care about the book. I just care about the license in the book. I don't care about the tech. So to every M&A, there is angles, and if you pick the right strategic buyer, the valuation of that buyer might be much higher than the valuation of a less strategic buyer who will judge you purely on numbers. So the answer to your question is, it depends who the buyer is on terms of what kind of value they place on you. For me, if I'm a strategic buyer and I need a tech team, you could be like 2 times the value that I would pay if I was a private equity house. These guys are the worst. Private equity houses, they'll like bleed you dry until they buy you. The strategic buyers are the ones that know how to utilize you much more so they can create value from what you have.
Right. And I mean, from my perspective and what I've seen in the past is, I think, yeah, finding the right buyer is the key, the one that cares about your technology, and it can enable other things in their business. But again, as you mentioned, there are buyers in the market. I mean, if it's even strategic buyer, just a larger brokerage, for example, will have their own technology. They might be less interested in your technology because, you know, they have their own, right? And they don't want to pay for two technology teams. But there are some that don't have, and they might value you much, you know, at a much higher multiple because there's a lot more value that they can derive from your technology team.
True that, and the fact that there's a lot of hype about the eToro and Robinhood valuations and potential IPOs and so on through SPAC and so on. I think that a lot of the sellers in this industry are feeling happy, and they're saying, well, wait, if eToro does it, why don't I don't, you know, I can do it as well. And then I think that this hype should be taken advantage by sellers. They should take advantage of the exits and the free advertising that's happening for this industry, and try and sell to wannabes that want to IPO. Because in order to IPO, you need to have numbers, okay? If you don't have the numbers, no one is going to look at you as a IPO material. So the people that want to IPO, they're in desperate need of buying tech, book, licenses, anything that could convince the investors that they have a story, the business case to sell. So sellers need to try and find those guys that try to IPO and copy and emulate the eToro success and the Robinhood success. And these are the ones that will pay the highest. If they're trying to exit on a private equity house or some buyer that is, you know, looking at it as a long-term play, I think you're not going to get the better multiples.
Right. It's like everything in life, it's all about timing, and it does appear that the timing is good to sell your FX business book right now, as there is craze in the market about SPACs and IPOs and the multiples. I mean, you can, whether or not you agree with them or not, and whether or not you can justify them or not, they are very high.
They are. There's hype. There's a lot of people discussing. There's a lot of strategic buyers. Trust me, I have mandates from many saying, Demetris, I want to buy something 10 million. Find me a book of clients I want to buy for 10 million. I want to do this. I want to do that. I want to buy a bank. I want to do. So a lot of people are thinking, how can I exit? How can I IPO? How can I do the same thing as these guys? In order to have any sort of business case, you need numbers. So they try to merge or buy someone in order to be big enough to be able to talk to the stock market.
Absolutely. So Demetris, last question. There's a great discussion about M&A. The last question is about you being in Cyprus, and I'm sure you have a lot of inside knowledge about what's going on in Cyprus. A few years ago, I've noticed there's a lot of brokers trying to exit the market, and I think that's likely has to do with what we discussed earlier, which is, you know, the drop in leverage following the newly imposed ESMA rules. What are the trends right now? It does appear to me that there's a lot more activity right now of people actually searching to buy brokers in Cyprus, and it's likely that interest is likely stemming from the fact that because of Brexit, a lot of UK brokers, at least for now, are losing their passport and rights into the rest of the EU. What are you observing, being local?
So just to clarify, Cyprus is kind of the hub for European FX CFD industry. So when we say Cyprus, we kind of say EU, because if I add the number of FX brokers in Cyprus versus the rest of the EU together, I think we will have more here in Cyprus. So I would say Cyprus/EU is very interested in order to make sure they continue uninterrupted access to the British market, okay? Which means there's a lot of buy-side interest of UK brokers in order to continue access. So that's one trend we've been seeing the last couple of years. There was the TPR regime, temporary permission regime, allowing access. The FCA came with an announcement yesterday saying, I'm cutting off the access to 120 brokers, which means that M&A is going to go crazy now. these 120 brokers, if they haven't taken licensing steps or acquisition steps, they're going to be blocked from servicing UK clients or accepting UK clients. Vice versa now, you have all these big UK brokers that already entered Cyprus in order to be able to enter Europe and cross-border. And there are some that, never believed that this is going to happen. They were, fingers crossed, Brexit will not be so hard. We'll continue taking European.
Things will be figured out, yeah.
We'll figure it out. Cyprus, why Cyprus? We're UK, we're prestigious. CISEC is not, whatever. Now these guys are scrambling because they realize that they can't service European clients. So these guys, even today, I got a request from 2 FCA firms asking to buy desperately because they need to continue their access to the EU markets. So trends both ways. Now, where the money is, if you ask me, the money is in Asia, the money is in Africa, the money is not in Europe, and the money is not in the UK. For the people that do traditional FX CFDs, they work a lot of, let's say, business in Asia, and they kind of sit in Cyprus and operate globally. They sit in the UK.
Right. And I think Cyprus, the reason why is probably because in order to be integrated in the global financial system, you need the financial license in Europe. Even though it probably it is not your revenue generator, you probably don't derive most of your revenues from the region, as you mentioned, Asia, North Africa. That's where the brokers kind of go these days, but you still need those licenses to be able to do the business, to conduct your FX brokerage business. And people and talent, yeah.
If you do a quick, let's say, interview insider Gallup and find out where everyone that deals with FX CFD sits, it will be London and Cyprus 90% and 10% rest of the world. There's a huge pool of people that migrated to Cyprus to deal with FX, and a huge pool that migrated to London to deal with FX and derivatives, basically. So these two centers deal with online brokerage derivative guys. You want to be where there is talent, where there is access to the proper license, where there is cheap services to be rendered, and that's why a lot of people set up shop here and they do their business in Asia. They set up their, C-level management, their compliance functions. I've seen a huge trend now. Australian guys buying Cyprus brokers.
I saw that.
The last 3 months, instead of dealing with UK guys, I'm dealing with Australian guys. They're like ex-Australia broker and Y Australia broker. We need to enter Cyprus and in Europe and basically revisit our, working through Australia, rest of the world model. So that's another trend that has been kind to Europe.
Right, and I think it's also driven by the restrictions imposed in Australia with the leverage drops and all those things.
We have worse restrictions. We're like 1 to 30 since 3 years ago, but I think that the fact that Australian regulator came out and said, if you hold an Australian license, you take Aussies. You are not going to take rest of the world. So they understood.
That's a showstopper.
Yeah. So they understood that you need to actually start thinking global presence, global footprint. So you've got your license in Europe. Well, 95% of the chance you'll be in Cyprus. You got your license in the UK, so you take UK, which is the prestigious thing. Then Asia you cover, or Pacific you cover with your ASIC license, and then you need an offshore license just to run all the rest of the countries that you can run unlimited leverage and make your profits, and the rest are just jewels in the big crown.
Right. Great. Well, Demetris, next time we do the episode, I guess I'll be at the epicenter of it in Cyprus.
Definitely.
That's the place to be, right?
Yeah, and I'd love to continue our chat whenever you have time. It's always interesting to discuss
always
with you
a pleasure,
these trends.
Demetris. Absolutely. Thank you so much for coming to the show. And I think we'll do many more episodes in the future.
Honor,
Thank you very much. Thanks
pleasure.
for your time.
My honor. Thank you, Natallia.
Thanks.
Have a good one.
Thank you. Bye-bye. Any views or opinions presented on this podcast are solely those of the author and do not represent those of Advanced Markets. Trade in foreign exchange or other financial instruments on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to invest, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or more of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading and seek advice from your broker or an independent financial advisor if you have any doubts. Anyone opening a live trading account needs to adhere to the laws of their local country, as such laws may differ from country to country. Advanced Markets expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of reliance on information provided through this podcast.